Hello, and welcome to the Murray Wealth Group's virtual presentation, Summer Quarterly Update. Thank you so much for joining us today. Please take a moment to review our disclaimer for today's presentation. Our CEO, Bruce Murray, and portfolio management team, Michael Hakes and Jamie Murray, take us through an inside look at MWG's investment strategy through some of our core stocks in the funds. Our portfolio management team has over 90 years of experience, which span every major cycle since the mid-1970s. For those of you joining us for the first time today, the form of this talk will be in 3 sections. First, we'll take an in-depth look at the markets. Next, we will move on to discuss our two pooled funds, highlighting our investment process for each through some selected focus stocks. And the final section will be a Q&A led by our advisory board chair, Susan Dalhoff, to give you, our audience, an opportunity to ask further questions of our portfolio management team. Please feel free to ask anything about the information you heard today, our current holdings, or any questions you may have about the firm. Without further ado, I'd like to pass it over to our CEO and CIO, Bruce Murray, for some opening remarks.
Good afternoon, everybody, and thank you for coming to our market update event. A year ago, we were at the top of about a 20% rally in the S&P 500, which then gave up most of it by the end of September. And then in October, we started the great rally that has happened over the past, 10 months now, that has taken the market almost back to its old highs. And we do not believe in market timing. We have found that you have to make 2 decisions: when to sell, when to get back in. And most people miss one of those 2 decisions when they do that. So we focus heavily on buying high quality companies that will power through the down cycle. They may underperform because they're high quality and people can sell them, and there's a big market for them, but they will rebound and lead the market to when it recovers and goes to new highs. And that really is our investment process. We will outline more of that today. So without further ado, I'll turn it over to Jamie to start the program.
Okay, thanks, Bruce, and welcome everyone. So let's do a brief market update before passing it over to go through the funds. But just as kind of Bruce alluded to, I think what we're going to focus this part of the presentation on is where we are in the equity market cycle, what we see for the next 3 to 5 years, and why we're still optimistic on the markets and think we're in for a pretty good little run here. But the focus of this slide is earnings growth is starting to take center stage again. So we're coming out of 2 years of very, very choppy markets. And now we think we're entering the growth phase of the market. And I do little air quotations for that because that's the growth phase. That's for the Goldman Sachs framework that we're going to walk through on the next slide. But this is a pretty nice phase of the equity market cycle. We're starting to see earnings rise again. So as I said, we're coming through this period where earnings didn't really rise for 2 years. They were choppy. They went up a little, they fell more, and then they started to rebound. And now we think we're moving back into a more consistent growth phase, which ultimately earnings are what drive higher stock prices. On the inflation point, it's obviously been very topical over the last year. We think it's going to be still a focus, but not the number one focus for the market. And we know now that the central banks around the world, with the interest rate hikes they put into place, they're much better positioned to handle the path forward for inflation. So whether it continues to fall, whether it rebounds and rises slightly from here, central banks are much better prepared for that type of market. Today on the S&P, we'll get into that as well, where it's trading. It's trading at 19 times earnings on a PE basis. That's a little bit elevated relative to historical. And we'll talk a little about why we think that is and why we're not too concerned about the current valuation of the market. And it does fit in with that growth narrative of where we are in the market cycle. And then the last point, just a quick note on supply chains, that those were very topical for the last 3-4 years, exiting the COVID lockdowns. We'll just get an update on what we're seeing there. So when we talk about this growth phase of the market, here's the chart, the framework that I was talking. This is from Goldman Sachs. And so we'll just maybe walk through it quickly just so we know what we're looking at. But this blue line here for each of the 4 phases represents the actual change in price. So the share price performance, market performance The darker blue line here is the PE expansion or contraction. So the PE multiple is one of the two factors that ultimately drive stock prices going higher or lower. Valuations either expanding or contracting. And then the other factor that can move stock prices is the earnings growth. So if your valuation multiple doesn't change and your earnings grow, your stock price should grow in line with earnings. And then if your earnings are unchanged, but the valuation moves up or down, your stock price will move with that. So it's always a factor of how both of these two are trending. And so if we consider the end of a market cycle when the market peaks and it starts to fall, typically the next 14 months is the despair period. And this is what I think we came out of or came through in the 2022 period. Obviously, there were some companies, hopefully you don't own too many of these in your portfolios, but some companies that are down 80, 90% and look like they almost have no hope of recovery right now. Obviously, even in some of the large cap names and some of the bigger sectors like technology, consumer, we've seen some stocks down 40, 50%. So it definitely was a very challenging market in 2022. And so we think we're through that phase. As Bruce talked about, we've had a really nice rally since October. So we're about 9-10 months into it. And that's into this hope phase. And the hope phase here, contrary to despair, it's all led by the change in the valuation multiple. So in despair, you see the valuations compress, and we saw that in September, October, multiples on the S&P were closer to 15, 16 times, with a little bit of earnings growth pressure. And then in the hope phase, you see that almost just blow right back up, almost reverse. And you see the PE multiple expand, and that's what drives the market. And I'll note that the earnings actually continue to fall a little bit in this phase. And that's what leads to a lot of market prognosticators to say, oh, it's just a bear market rally, or look, the fundamentals are terrible. Because in the short term, the fundamentals still aren't great, but the market's always forward looking. It looks through that shorter term dislocation in the markets and back to the long-term growth. And then you move into this phase, the growth phase. And this is where I think we're entering right now. This is typically a 3 to 4 year period where you get nice earnings growth. You get the most earnings growth in this period, as here by this the medium blue line on the far right. And you actually see the valuation multiple contract a little bit. So you still have positive share price performance. You still have good performance for 3 or 4 years, but it's that earnings growth overpowering that contraction in the multiple. And so that goes back to where we're saying the markets are a little bit expensive right now. We expect that PE multiple to contract slightly over the next few years back into its historical range, but we'll have enough earnings growth to overcome that contraction, and we should see share prices move higher. And then the fourth phase, which we probably came through in the 2020, 2021 market, is the optimism phase. And that's where you see, we're back into valuations usually hitting their peak levels before they start to fall. And just, again, looking at the market where it is today, you can see here, we're trading just below the 4,500 level. As Bruce talked about at the top, the peak here in late 2021, right at the 4,800 level. This is the S&P 500. So not quite all the way back, but definitely a nice rally off the bottom lows seen last summer and fall. And as I said, we're trading at about 19 times on the PE multiple range. That's a little bit above the historical average. So we would expect to see that trend back into that range over the next few years. The other reason why we're optimistic, we see earnings starting to rise again. So this is the earnings estimate for the S&P 500 looking out 12 months. And so the way to look at this chart is, in December 2021, over here on the left side of the chart, the forward earnings estimate for the S&P would be 224. Those continue to move, and then we peaked early last year in 2022, and then the estimate started to fall. That's what really also helped drive the stock prices down as we went through October, November. But then, as we said, markets tend to bottom before estimates do. So even though estimates continued to fall into January and February, we saw the market already starting to rebound and start to move higher. And that's what we see here. We've seen the earnings estimates start to rise now. So the earnings are moving back in an upward trend. If we were to talk about the 2024 earnings estimate, so where's the market going to be looking at in December of this year? That's about the 242 level. So we should see earnings estimates surpass their previous peak. which will again just provide some more support to higher equity prices. And then just the quick notes on inflation. So we did talk about this a little bit, but we've seen inflation back off meaningfully since last summer when it peaked in the US at 8.5%, all the way down to 3%. And it's even important to note that right now, the shelter component of CPI is still the largest driver of inflation right now. So think in the US, home prices, rent prices went through a big increase in 2020 into 2021. Those actually peaked almost a year ago in mid-2022, and they've come off slightly. So we expect the housing component of inflation to actually be a bit of a drag on the inflation index moving through the back half of the year and into early 2024. And that's going to, again, provide some inflation relief. Now we are seeing some counter-cyclicality in the oil prices. It's moved up a little bit, which may start to impact the inflation numbers slightly in the back half of the year. But I think it's safe to say we're anticipating an inflation rate in the range of 2 to 4% for the next 12 months, which is a huge improvement from the 7-8% we were seeing last year. And then when we talk about at least the US Federal Reserve, the Fed funds rate, which is the Federal Reserve short-term interest rate, is right now around the 5.5% level. That's obviously a huge step up from where they were a year ago. And we just think now the Fed's much better positioned to handle the inflation rate. We're seeing short-term interest rates above the interest or the inflation rate. And so that means if inflation does stay a little bit persistently strong, the Fed doesn't necessarily need to continue increasing rates. They can maybe just hold them where they are a little bit longer. And if inflation does back off, that gives the Fed ample room to start reducing those rates. And then just quickly on the supply chains, this, again, we always believe that the supply chain dislocations were the big driver of inflation. There are definitely some systemic issues like the carbon taxes and wage rates are definitely rising and labor is a little bit tighter, but we think that a lot of the big inflation we saw is just due to supply issues, which are starting to normalize. And here's one is the auto supply chain. So auto parts were in short supply. Obviously, if you don't have every single component to complete a car, you can't ship them. So you can see here through most of the 2010s, auto production was right around that 17 million level annually. And then as we got into the COVID lockdowns, and in particular in 2021 is when it was really felt, those rates fell. And now they're just starting to rebound almost back to that level. We expect them to get back to that 17 million range on an annual basis in the back half of this year and into early next year. And then there's still a lot of inventory that's being depleted. So it's going to take another year probably to refill that inventory. But just one more source of some inflation relief, as at least in the auto sector, we still think it's going to be coming through. And then the other, which was a big, and this is just the flip side of where auto production, auto prices could go. If we think back a year and a half, it was all about the chip shortage. And this just goes back to Q2 of 2022, and this is from Gartner. But we're actually seeing now the chip market, in many cases, is actually in an oversupply situation. So we went from a severe shortage in 2021 all the way to an oversupplied market 2 years later. And now we're seeing chip prices start to come down. And the better availability of chips obviously helps many different supply chains. So we still think there is some pressure to be let out of supply chains, which is going to help the inflation picture going forward. And that is the end of our market update. Just to wrap up, we think that the growing earnings is going to provide more support for the markets after a 2-year period of stagnation. We're in that part of the cycle where earnings estimates typically rise at a nice rate annually. And as we said, stock prices follow earnings. It does mean there won't be pullbacks, there will be corrections. But as we look over the charts on a longer term, we think we'll be seeing higher prices in 2024 and 2025. As well, the Fed is in a good position to adjust the inflation path, whether that be up or down. So we think that's one headwind from 2022 that won't be as persistent going forward. And then as we're in the final stages of lapping these COVID-induced market dislocations, that should improve earnings should improve earnings volatility. It should improve supply chains. It should improve inflation, and that should help companies continue to deliver strong earnings. And from there, we're going to pass it over to Mike, who's going to walk us through the growth funds.
Hey, thanks a lot, Jamie. And thank you to everyone for joining us on the call today. Bruce and I are going to talk about the two funds we offer, the Global Growth Fund and the Income Growth Fund, and give you a few examples of the holdings that we have in each fund. And you can see a description of the two funds on this slide, and there are some important similarities and differences. The similarities are that they are both concentrated portfolios. So each fund holds around 35 securities, so every investment makes a difference. We manage the two portfolios in the same clear and consistent way, and our process and approach has not changed in the last quarter, the last year, 3 years, 5 years, and longer. We take a bottom-up approach to our stock picking, and our holdings are usually in the portfolio for many, many years. The key differences are that the Global Growth Fund gives investors exposure to the world with 75% of our holdings in global stocks, whereas Income Growth is more Canadian focused with an 80% weight in Canadian equities. Global Growth aims to target companies that are growing faster than the market. They tend to be leaders in their space with superior revenue, profitability, and cash flow prospects. Income Growth applies those same stock picking principles, but to more mature industry leaders and more focus on higher dividend yields and dividend growth. For example, you can see the differences of yield on this slide. Global Growth has a 1.6% yield, and Income Growth has a 5.9% yield. You can also see the sector exposures. Global Growth has exposures to communication services, information technology, consumer discretionary, and healthcare, and those amount to over half the portfolio, whereas Income Growth generally invests in more mature, high-yielding sectors, financials, utilities, pipelines, and energy, and those make up over half the portfolio in this case. Global Growth is also typically larger cap than Income Growth. You can see the ranges on the slide here as well. So there are some big differences between the two, and they are good complements to each other. So let's dig down into the Global Growth Fund. On this next slide, you can see a snapshot of the fund as of June 30th, 2023. The fund was launched June 30th, 2015, and you can see the performance since inception as well over several time periods. And I want to say, like, happy birthday to the Global Growth Fund and Income Growth Fund. These guys are 8 years old. Hey, how good is that? We're very proud of the performance over the years. And you can see our benchmark here that is weighted 75% MSCI World and 25% TSX, S&P. And you can see the fund has done quite well over the time period that is shown on both an absolute basis and versus its benchmark. And you can see on the bottom part of the slide how a $10,000 investment at inception would has grown over time, and how much you would have had on June 30th, 2023. Let's look at the fund's characteristics and sector exposures. The characteristics of a fund you own or are considering owning are very important, because you want to make sure you are getting what you expect. From a characteristic standpoint, the top box on this slide, there are several metrics shown. And as a growth portfolio, you would expect the yield to be lower than the benchmark, as the companies that we invest in are reinvesting for growth versus using the cash flow to give back to investors. And you can see that the Global Growth Fund has a 1.5% yield versus its benchmark of 2.4. The next three metrics are also interesting. You would expect that the forward PE of the portfolio would be actually higher than the benchmark, because again, it is a growth portfolio. But actually in this case, it's a bit lower, 15 times versus 15.8 times. So overall, the portfolio is cheaper than the benchmark. But in this case, you're actually getting a higher EPS growth over the next 12 months and longer term. The portfolio shows 17.2% EPS growth over the next 12 months that are expected versus the bench at 15.2. Over a longer term, 3 to 4 years, the portfolio is expected to generate 13.3% EPS growth, whereas the bench is only at 8.6. It would seem that you're getting quite a bit more growth at a very reasonable price in terms of a PE multiple. Active shares, also shown on here, is the difference between portfolio holdings between the portfolio holdings and its benchmark index. A portfolio that replicates the index has an active share of 0. So active share can help identify closet indexers. Those are people or portfolios who claim to use active management, but don't actually differentiate their portfolio from the index. Global growth has very strong active share at 88.3%, which is consistent with active management. On the bottom of the slide, it shows sector exposures. And you can see we have very, very strong weights in consumer discretionary, communication services, and industrials, and less exposure to consumer staples and materials. So move to the next slide. Not only do we like to measure ourselves versus the benchmark, we also like to see how we're doing versus our competitors. This is our accountability check to our unit holders. And this slide shows Global Growth Fund and its ranking in the GMR, that stands for Global Manager Research Survey, which has over 270 global funds in it. And just to give you a flavor of competitors in this survey of the 270, we included some of the bank funds on this slide as well. And you can see our performance, the Murray Wealth Group Global Growth Fund, absolute performance is very strong over the time period shown. And our quartile ranking is also good, being first quartile across almost all periods. For those not familiar with the quartiles, basically take the 272 funds in the survey and you divide that by 4 and you get 68. So 68 funds would be in the first quartile, 68 funds in the second quartile, and so on. And the quartile that you fall in depends on your performance. The Global Growth Fund was in the first quartile across almost all time periods. In fact, we ranked quite well, very high up within the first quartile group that we were in. And also, we were included for the first time in another survey last quarter, which we meant on our previous call, the RBC survey. So if we go to the next slide, you can see that their global equity category includes 108 funds. This survey shows percentile ranking, not quartile ranking. So out of the 108 funds that were in this survey, which we were one of, we were number 1 or 2 over 1 quarter, 1 year, 3 years, and 5 years. Over 2 years, we were about 44th out of 108. So we would have been in second quartile if you put us in a quartile group. Also on the slide, you can see what they call a 4-year rolling performance for the period ended June 30th. And what that means is, for example, is if you look at the year ended June 30th, 2021 for the Global Equity Fund, it delivered a 4-year CAGR of 18.77% over that 4-year period between 2018 and 21. And you can apply the same method for 2020, 20, and 22 and 23. That's the compounded average growth rate you achieved in the previous 4 years to the end dates. So overall, we're very pleased with the fund performance. So let's move to examples of a couple of names that we have in the portfolio. I'll lead it off with Airbus. Airbus has been in the global growth portfolio for well over 5 years, and we hold it at about a 4% weight. It operates in a duopoly with Boeing in a manufacturer of wide body and narrow body aircraft. And the barriers to entry in this industry are very high. And the continued growth of the middle class around the world continues to create a strong headwind, create a strong growth in demand for air travel and airplanes. For example, did you know that India's in-fleet service, that's India's total domestic airline fleet, totals only about 700 airplanes? That's less than Southwest Airlines for a country with a population of 1.4 billion. So there's a lot of growth to happen in India, and it is happening in the low-cost carriers, and the government is starting to invest in infrastructure such as airports, but there's a long runway for demand and growth in India. Also driving demand for Airbus and Boeing are fuel efficiency from the airlines. New airplanes are more fuel efficient more fuel efficient. This is by way of engine design and improved materials technology, and this has led to an upgrade cycle amongst the carriers. They're looking forward to improve their costs and efficiency profiles. As a result of all these factors, orders for new planes have grown rapidly, creating essentially a 10-year backlog for some planes. The A20, for example, is sold out until 2030. And during the most recent Paris Air Show, Airbus received 801 new orders. That's over a year's worth of deliveries during one air show. Pretty amazing. And you can see that the top chart on this page that shows the Airbus backlog by region and by fleet. So a very broad backlog by region, very, very well distributed around the world, and also by airplane. In the shorter term, the biggest opportunity for Airbus continues to be the supply chain, as we've mentioned numerous times over this presentation. Airbus works with more than 13,000 suppliers worldwide. In 2021, 2022, much of the delays were due to engine supply chain issues, and Airbus had to reduce its deliveries in 2022 from the initially expected 720 to a revised lower amount of 660. But when we look into the second half of 2023 and 24, most of the delays are expected to be in interiors and electronics, but all the supply chains are being resolved. And we expect Airbus to improve annual deliveries to close to 1,000 by 25, 26. And you can see here Airbus June deliveries on the bottom of the chart and how they were impacted by COVID and how they are rebounding with June 23 deliveries in orange back up to 72. We would expect the growth of Airbus, revenue growth of Airbus in the high single digits to low double digits in the next 5 years, and margins to continue to recover, which will drive strong mid-teens EPS growth for Airbus in 24 and 25. And we expect that stock will react positively as they are successful executing this plan. And this will drive the stock up, we hope, over the next 18 to 24 months by about 30%. So I think that's a good flavor of Airbus. Now, Bruce is going to talk about one of our newest positions in global growth, Thermo Fisher.
Yes, thanks everybody. Yes, Thermo Fisher is a classic growth stock. This is a company that dominates its industry. They are a giant, 44 billion in revenue, and most of you probably may never have heard of it. They have gradually through acquisition acquired the leading position in scientific research and medical research, and even medical treatment and a lot of things like that. And the company is sort of, the pick and shovel suppliers to the science industry anyway. And you can see on the chart on the right here, the historic R&D spend in large tech, pharma and biotech, and it's rising, and, it's been pretty steady in the, I guess like 5 to 10% range, with the odd year popping up into high teens. And, the next couple of years, this chart's actually probably a bit conservative in viewing the future outlook. Future forecasts are often more conservative than they really are. And so with that, we just think this company is going to continue to grow and deliver. It's not going to be a spectacular home run in any 1 year, but we just think it's going to be the type of stock that delivers that 10 to 15% growth that we like for the core of the portfolio. It's a relatively new addition to the portfolio. We just added to it in a couple of months ago, as we sold another company in this industry that had done extremely well, and we felt the PE of that company was too high. Anyway, and so this the second chart that Jamie's put up gives you the leadership in the markets. First of all, pharmacy, but they're right across the spectrum. They're in making the equipment and the materials for the healthcare industry, but they also are deep into services and consumables of these instruments and the treatments that they need, and they're followed that into patient care. And so you can see that it's still largely a Western world, Europe and North American based business, but Asia Pacific is becoming more important. And then on the product chart, you can see that 18%, it's like a lot of businesses where you probably sell the machines that use the consumables at a cheaper price and then make very solid margins on the consumable part. And so that's Thermo Fisher, that stock that, it does sell at above 20 times earnings, but we think it continue to hold in that range and generate 10 to 15% earnings growth. And anyway, so with that, we'll move on to our other fund, the Income Growth Fund, and I'll talk about that as well. The Income Growth Fund, unlike the Global Growth Fund, we're focused on just trying to generate more dividend income per annum for each unit in the fund, and we do that by we trade around between companies that we see, and we have valuations on the very tight valuations, and when a stock drifts off, we'll buy it, and when a stock heads up, we'll probably reduce it a little bit and move into some stock with higher yield. But this stock again has done, excuse me, sorry for my phone. This stock again has done, their portfolio has done quite well over time. We had a couple of the last 6 months to a year have been a little tight, as the income stocks obviously were affected by the rise in rates, and we saw some of our core holdings, like for example Capital Power, which is one of our favorite stocks in the sector. It sort of fell from 50 to 40, but meanwhile they continue to focus on, it's got a very nice dividend of close to 6%, and they increase that dividend every year by 6%. And so that's the story of this. Jamie, next chart, please. And so we put up some of the characteristics of this fund. Our portfolio, we're showing at when this was last read, was 6.2. It's about 5.7 today, so 5.9. And the benchmark, which is the total stock market, in a sense, we do have 80% Canadian, the Canadian stock market, 20% US, because we are selecting from those, but just at the higher income level. And again, as Mike's run through the growth rate, so you can see the dividend yield well above the benchmark. You can see the forward PE of the company is well below the market. You know, the market's 14, 15 times, as we showed you on that other one, and this portfolio has a PE of about 10%. Now, on the other hand, though, given the EPS growth rate longer term is virtually zero, so we do need to trade this around, and probably this is a little bit underestimated. But within the portfolio, you can see the portfolio weight energy, which we've got a large weighting in pipelines and utilities, and some of the energy stocks themselves, which are all trading substantially at very low valuations due to the fact that people, the green energy move has taken a lot of the big institutions out of energy stocks, and there's always the fear that prices are going to drop. Real estate, again, rent, we've got good holdings in the rental area. And then financials, the Canadian banks and insurance companies are the core of this portfolio and always will be. And then we've got market weighting in utilities. We do have a weighting in materials that we think we're taking advantage of a couple of companies that are paying nice dividends at the moment. And you can see down the list, the only other sector we have a weighting in that's even material is industrials and information technology, but we're half that market weight. Jamie, please. So this fund, our GMR survey, we're not really in a great category, and so the category we're in is companies that are focused on Canadian US investing, and a lot of those are Canadian growth funds that actually put in companies like Microsoft and Google, etc., to get the US weighting. And so, well, on a 3-year basis, the fund has done well. On this survey, it's been hit by the rise in rates, whereas a lot of these other funds benefit from the market move. But we did pick a couple of competitors out of that group, which are similar to us: the Manulife's dividend fund and the 1832 equity income strategy. And you can see we're very comparable to them over this time period. Thank you, Jamie. I gotta let Jamie talk about Gibson Energy, which is one of the newer additions to this portfolio. And
Yeah, thanks. So I'll talk quickly about Gibson, and just a quick note on the three companies that we each focused on. We write up a focus stock every month. It's on our website, or you can sign up for our newsletter if you haven't. And you can get all these in that. But Gibson's a name that I wrote up in June, and why we wrote up Gibson is they actually just completed a very large acquisition down in Texas. And they bought a terminal that provides for oil export on what's called they're called VLCCs, which is a very large crude carrier. And it's the largest oil tanker in the world. And it's one of only two facilities on the US Gulf Coast that can actually dock one of these large carriers. So it's a really interesting asset. They bought it from a private equity company, and Gibson believes that they can bring a lot more oil into that terminal. That's very well positioned, and that should be a great growth leg for Gibson for the next, call it, 5 years. And that's important because Gibson, I think there's general consensus that's a very, very well-run company. It's very strong operationally and financially. But given what's happened in the oil sands market over the last 5 years, we've seen almost a slowdown of new oil sands projects. And so Gibson's main business prior to this acquisition, which is still complementary, was oil storage in Alberta. And so Gibson had the best positioned oil storage tanker facilities where oil from oil sands, and mostly from oil sands, but other oil fields would flow in. Gibson could store them there, and then they can be blended or moved onto other pipelines. So if you want to send oil to Vancouver or down to Texas, or put it on a train, or even onto a truck, Gibson has the terminals to do that, and the storage available. And so they would sign these very long contracts with companies like the Suncors and Canadian Natural Resources to take their oil, store it, and then eventually would get shipped onto another pipeline. And so that business has been a great business, but the growth has just been slowing given the lack of new oil sands projects. There wasn't really new demand for these tankers. So this acquisition in South Texas makes a lot of sense to us. It gives them a new, another option to invest in to keep growing. And the company has done a good job growing over the last 5 years. The payout ratios dividend payouts continued to grow. At the same time, the payout ratios, the amount of their earnings that they actually are paying out, has continued to decrease. And they've also been paying off debt and buying back stock with some of their excess cash flow. So a very well-run company from a financial management standpoint. And now with this new asset, we think this provides the next growth leg for Gibson. And their yield today is at 7.5%. We think that's a very great yield. It's very conservative, just about a 60 to 65% payout ratio. And the company, again, has a very strong financial backing. So, we think this is a company that's going to continue to be able to grow that yield at 5 to 10% per year with low downside. And as we've seen oil prices perk up, we think that'll translate into the stock price moving back into at least the mid-20s over the rest of the year and into 2024. And so I think that pretty much wraps it up for our formal presentation. I know some of you have sent in some questions, and we're going to have Sue Dalhoff, our advisory board chair, moderate the discussion. But as always, we'll put up the portfolios up for you to peruse through. And if you have a question as well, you can enter it into the chat or the Q&A box, and we'll try and get to as many as we can.
Thank you, Jamie. And thanks to all of you who sent in your questions either ahead of time or during the presentation. There's quite a number of them here. We'll try to get through as many as possible in the next sort of 15 to 20 minutes. For those of you that have a hard stop at 4 o'clock, please feel free to leave us then. We understand, and thank you very much for taking the time to participate in today's call. So let me go directly to the questions. The first is a two-part question as to what effect a couple of issues will have on the markets. I'll address this to you, Bruce, but certainly Jamie and Mike, feel free to add to the discussion if you like. What impact will the Fitch rating agency's downgrade have on stocks and the economy in general is the first question. And the second is, As countries onshore their manufacturing due to China's lack of reliability as a partner during COVID, how will this impact markets? Go ahead, Bruce.
Well, let's first of all talk about the downgrade. Historically, rating agencies, they look at lagging data, and so they're usually late in downgrading. I mean, if you look at the US, we went through the great debate, for those of you paid attention back in May, June of the debt ceiling and extending of it, and this is a periodic thing that happens. The US economy is growing very nicely, so you can obviously handle more debt. But you know, it is a bit of a warning that politicians will be able to back off. There was a lot of excess money put out by a lot of countries during the pandemic, and you know, the Biden administration, when they got elected, chose to relieve some student debt, which was a fairly substantial amount. That is now probably behind us. As always happens, employment strong, so therefore taxation will be strong. Well, it is, I don't believe it's going to be a material event to the future, but it is more of a warning to politicians that, you know, and the public itself will probably be electing politicians, more politicians that are going to be conservative. So as to China, I mean, we're seeing China is starting to feel the effects of the one-child policy. The labor force has stopped growing. Prices are rising. We're seeing speculation within China. As people get older, they tend to get more conservative. And so the real estate, there's been the real estate, quote, real estate bubble in China. And I'll just mention that savings in China, often among the wealthy, when we were interviewing companies or something, we'd talk to somebody that PhD is a university professor or something, and how do you save? Oh, I own five apartments, but the apartments weren't furnished and they weren't rented out. They were just sort of left in a semi-finished condition. They didn't have the finishing, so nobody's living in them. And there's speculation that they would just go up in value over time. And that really led to a lot of the land speculation bubble. And we've seen 2 or 3 real estate crises, and there's one going on currently with you know, a company that's you know, 20 times the size of anything in North America in the size in real estate development. So that's what's going on in China. Also, the tensions between you know, China and the Western world over Taiwan, and you know, China moving back to more of a sort of rotating dictatorship, you know, a dictatorship under the current leader. And so, yeah, I think it actually is going to present opportunities. If we do a lot of factory construction in North America, which it will be slightly inflationary, which would be one of the negative effects of that. But you know, the business activity will be pretty good and support long-term market for a lot of goods and services. So I treat it as a bit of a bullish event for North America anyway.
Okay.
I'll leave that too. Thank you.
Thank you, Bruce. The second is a stock-related question, and I'll address that to you, Mike, if you don't mind. Do you have a favorite pharmaceutical company?
Wow, thanks for the question. I just broadly say that currently we have about an 11% weight in the healthcare sector in the Global Growth Fund. And the names we own include Boston Scientific, and they make medical devices such as stents, catheters, defibrillators, and pacemakers. And actually, I'm happy to announce that I'm currently using none of their products. But we also own United Healthcare, which is in health insurance and hospitals, and Thermo Fisher, which Bruce just talked about. But the 2 pharmas we do own in global growth are AstraZeneca and Eli Lilly. By far, the most exciting name we own is Eli Lilly. I'm sure you've seen the news over the last news or headlines over the last 6 months to a year about some of the new weight loss drugs that have entered the market. Wegovy offered by Novo, and Mounjaro offered by Lilly. that Marniano is currently only for diabetes, but it's expected for weight loss approval this fall. These drugs are helping people lose around 20% of their body weight, plus or minus. And this brings new meaning to the phrase heavy hitters. Heavy hitters. I didn't say that quite right, but I needed better execution. But the benefits of these drugs is becoming even larger. Just last week, a study showed that the benefits to heart health from patients taking from taking Wegovy, for example. So people are now getting super excited about the 230 other health issues caused by obesity and how these drugs might help. I use the word exciting to describe Lilly because it's not without risk. It is extremely expensive. In fact, it has become even more expensive since we bought it about a year ago. We thought it was expensive then. We bought it about $320 last June. We had a 2% weight and the stock did very well. It went about 40% as some incrementally good news hit the markets, and it hit 440 through the summer. And we actually sold it down to 1.5% because, it pretty much hit our price target. And then we thought the stock was getting exuberant. However, there was room for more exuberance because the news about the benefits to heart health was released, and the stock has gone up to $530. So that's almost 65% from when we first bought it. So while the prospects are great for those drugs, those types of drugs, there's a chance it could be priced to perfection. And we didn't talk about this during the presentation really about our process and approach, but we are very conscious of valuation or how much you're paying for a stock. And sometimes stocks get ahead of themselves and reflect a lot of that exuberance, almost to the point where Jamie showed the slide of Goldman Sachs saying hope, growth, optimism. Well, some of these stocks reach almost cult status for valuation. And as another example, I would say that Bruce talked about Thermo Fisher, and he alluded to the stock we sold. Well, that stock was called Intuitive Surgical, and they are a global leader in robotic surgery and minimally invasive care. And it was always fairly expensive when we owned it. And we had good upside to the target, but it also became very expensive as investors got super excited about increasing procedure growth after COVID, and the stock rallied very, very strongly, hit our target, we sold it, and we bought Thermo, as Bruce mentioned. Anyway, I think that's while Lilly is super exciting. AstraZeneca is probably our biggest weight in the portfolio. You can see here, where's Astra? Almost 5% of the portfolio, because they have a broader depth of product pipeline, and it's much cheaper. It trades about 18 times, 19 times earnings with a good visibility going forward. So that is going to give you a exciting stock, but tempered because of the valuation, but something we're really enthused about longer term as well in AstraZeneca. Thanks for the question.
Thank you,
I'll
Mike.
just add that AstraZeneca is a leader in a lot of cancer treatments that are being developed by, we're finding ways that the human body can restrict cancer itself, and they're a leader in a lot of those technologies. I'll leave it at that. So thank you.
Thank you. The third question is an income stock related question, and I'll address that one to you, Jamie, if I may. Is this a good time to buy EIF.ca for income, or do you prefer something else like the Alaris units?
So I'll put up our portfolio here. You can see that both of those companies cracked the top 10 in the portfolio. So, I think we like them both. Alaris gives you a little bit higher dividend yield versus exchange. So if that's just what you're looking for, maybe Alaris is a better buy in that sense. But we like both companies. Exchange Income, just so everyone is aware, it's a company that has two major divisions, aviation and manufacturing. And it really finds these niche businesses. It's almost run a bit like a private equity company where the Exchange Income management team purchases these companies. They still let the existing management teams run them. And then they allocate capital to them as they have different growth opportunities. And so Exchange Income, they really dominate the regional passenger network in Northern Canada. So think Northern Ontario, northern prairies into the territories. But they also have businesses like they have contracts to do the medevac air ambulance services for many provinces. They own a flight training school. So they have lots of businesses in the aviation sector. They also have a airline leasing and parts business that sort of complement each other. So they can use the airline leasing and parts business to supply their own aviation facilities. They can use their pilot training school, the feeder system for pilots for their own internal operations, because there's a pilot shortage right now. So, and they do similar stuff on the manufacturing side. So that's what we like about Exchange. Alaris is also a similar company, but more just on the financial side. They are an alternative lender to companies. So companies who can't get traditional bank financing at a rate they like, but maybe it's a founder who doesn't want to give up a big chunk of their business who needs financing. They go to Alaris. So they have an interesting loan portfolio of preferred shares that they build in escalating distributions paid to Alaris that just get paid straight out to the investors. So two companies that we like, both with nice yields.
Thank you, Jamie. Getting back to a more broad-based question here, and I'll address this to you, Bruce. Interest rates are a concern. People are being forced to sell their homes as their mortgages are becoming too expensive for them to afford the places they live in. And carbon taxes are driving prices of every product up, adding to inflation. How will this play out with consumer confidence? And then I assume how will it affect the markets as well?
Well, again, thank you for that question, but those are two sort of very broad questions. And that's what we raised interest rates to squeeze the consumer to slow inflation. And that's part of the consequence of slowing inflation is that the marginal people cannot buy, get squeezed out of the housing market, therefore forced to downsize. And the economy, though, basically anybody who wants to get a job can get a job. You might not like to pay, but there's tons of jobs out there still. And maybe these are really deep questions, but maybe this is as older people live longer, we have to raise pension, tell people they have to work till, France, they're struggling right now. This summer they had to raise, they raised the retirement age from 62 to 64 or 63 to 64, something like that. And we had protests in the street, etc. And so it's possibly just part of the political process, political economic process moving. But I mean, we're into a forward-looking world where, like the medical companies we see are coming up with ways to slow disease, to increase lifespan. AI technology is going to, we don't even know what it's going to do, but I mean, it's going to bring massive efficiency right across the white sector collar of the economy, and creating lots of opportunity, lots of income. And I think it's going to be anti-inflationary. And so, I mean, these other two factors are here. They're here in the short term. Countries like Canada, where we have, we got more land than anybody per capita on the face of the earth, but we don't seem to be able to get houses built. Is they're more political issues, and we need to get policies that people have to be comfortable with, policies that will allow houses to be built. And that's probably hasn't been solved in my lifetime, may not be solved in the next lifetime. So those are the sort of things that are happening here. And you could also add all the major cities in the world, nobody can afford houses, whether it's New York, London, Paris, Toronto, maybe Montreal. But I still say, if you want to own a house, you can go to Windsor. You can probably get a house in Windsor for a very good price. You probably get a house in Saskatoon, or you can, most of the Maritimes, you could probably buy houses in. So I mean, and artificial intelligence and open communications are going to make it easier for people to work from distant locations, as we're seeing, and that may in itself be part of the solution to housing. So, I mean, these are issues, but I don't think they're issues at the margin. They're not issues that are going to slow Eli Lilly's weight loss sales down.
Okay, thank you. Thank you, Bruce. Maybe while I have you on, perhaps you'd like to take this one as well. What is the minimum investment for your funds?
So we have a minimum investment of $250,000, but that is per household. So and it's not a single account, but we you bring in RSPs, TSFAs, your wife, your children, your great uncle, they can all be included in that $250,000.
Okay, thank you. Jamie, I'd like to send one over to you now, talking about Aritzia. And it's, overstocking issues. I guess it's been in the news a bit. Would you buy more now, Jamie?
Yeah, so Aritzia, no, this is just as of June 30th, 2023. It's closer to around a 4% weight in the portfolio today, as the stock did fall about 20% when they put out their last earnings report, and it's down fairly substantially this year. Now, I mean, it was the top performer on the TSX if you go back a year ago. So, sometimes you got to take some medicine with some of these high growth names. And that's really what's happening with Aritzia right now. I think most people have probably heard of it in Canada, but it's a leader in women's fashion, expanding very quickly in the US. And they have a huge runway, we think, in the US to continue to add new store locations. If you think in the GTA, or in Ontario, there's about 30 Aritzia locations for Ontario, whereas like some of the bigger states like California, New York, which are 3 times the size, there's 5, 6, 7 locations. And then many major cities across the US are just getting their first Aritzia location. So big cities like Atlanta and Minneapolis with 2, 3, 4 million people only have one single Aritzia. So there's lots of room for them to continue to add new stores eventually internationally. That's what we liked about the company. It's been operating for 35 years and has done very well through that time period, growing from a single store to its current 120 locations approximately. And it's always done that at a very high return on equity, which is, again, one of our big things we look at. How profitable is this company? Can it grow within the means of its own cash flow? And does it generate excess cash along the way? And Aritzia has always done that. It's just this year they've hit an inventory issue where it kind of goes back to the COVID supply chain question or discussion I was sharing earlier. Aritzia was having so much trouble getting stock in the pandemic when their sales were exploding. Their sales in the US were up 60, 70% year over year in 2020, 21. And they were short inventory and they were ordering, and the supply chains were all bungled up and it was taking things forever to come. So they'd have to, wait 6 months to get an order. And then all this very, very quickly reversed late 2022, and the supply chains just opened up. And then all of a sudden they had a flood of inventory come in that they were expecting to take, to come in over the next 6 months. And now they're in that position that no retailer really likes to be in, where they have a little bit too much inventory. They need to sell down stock. They might have to market a little bit more aggressively. And so that's what's been happening. And it's really weighed on the profitability this year. But we see that profitability coming back quite strongly over the next couple of years. I think even the consensus earnings estimates on the street are about $2.50 for 2024. And that's with the stock being at a $24 share price today, that's just about a 10 times earnings. Now, this was a company that was trading at 25 times when times were good in 2021. So maybe you don't want to put that multiple on it, but I think putting a 15 to 20 times multiple on Aritzia is more than fair. So even a 15 multiple gets you a $35 stock price. And then we do think the earnings can grow quite quickly off that $2.50 level, upwards of $3.50 to $4. So this is a name that we still like. We're not buying it as aggressively until we see a couple of clean quarters to see that inventory situation is getting under control. But this is a company that still has a long runway. Their sales are still much higher per location today than they were even 3-4 years ago. So that's not an issue. It's just about getting these margins back to where they need to be, which we think will happen in the next couple of years.
Thanks, Jamie. And I've had several questions on this stock now, so I wonder if we have just time for maybe 1 or 2 more questions here. And this is Northwest Healthcare Units. The caller's interested in the outlook for the company with respect to management changes, strategic review, payout ratio, just, what do they look like going forward? Jamie, if I could ask to you as
Yeah,
well.
I can take that one. So yeah, Northwest has been it's in our income fund. I'll put that up here. I feel like we're going the wrong way. There we go. So Northwest, it's a real estate investment trust. It owns healthcare properties around the world, in Canada, the US, the UK, Australia, some other European and Brazilian assets as well. So a behemoth in the healthcare real estate space. So think hospitals, medical office buildings, and the like. And what really is, they've just been affected by the quick rise in interest rates. They had a little bit too much short-term debt that has now, as interest rates have gone up, they've had to pay higher interest on. And the other disappointing thing that happened, which I think a lot of investors were hoping and banking on, was they were talking about doing these 2 joint ventures with some of their US assets and their UK assets. And they had partners lined up, and they were going to put these assets into a joint venture structure. They would get a bunch of cash proceeds. The debt would come off of their books and go into the joint venture. And then they would get management fees for those assets. So they would still manage it and take a management fee, but that would have really helped out their financial profile. But unfortunately, the continued increase in interest rates has put a damper on the real estate market for medical sector, and both of those JVs fell through. And then just this week, the CEO, who actually owns a huge chunk of the company through his investment company, about 8 or 10%, stepped down. I think there's some of the larger investors who weren't happy with the performance of the company, and so now they promoted a couple of the second in command type managers into the CEO and president position, and the board of directors is undertaking a strategic review. So it's kind of a little bit of a wait and see what happens with this. I mean, the one thing we would say is the collective value of the assets for Northwest is probably close to $10 to $11 per share. The share price today is trading around $6.50. So if the strategic review comes to the conclusion that they should sell off the company bit by bit, they might be able to recoup $10 or $11 per share of value. Maybe they sell off a couple of divisions and it becomes a smaller REIT, but with a stronger payout ratio. We kind of need to see what happens, but there is good asset quality and the values there underlying. It's just been the rise in interest rates has put the real estate markets that they operate into a little bit of dislocation.
Thanks, Jamie. And I had one more, if you wouldn't mind taking this. Why have energy stocks been so hot in the last few weeks?
Yeah, so energy
as well.
Yeah, energy stocks. We've liked energy. We definitely increased our weighting following the Russia-Ukraine invasion in 2022, but we do have, I think, a better outlook for the sector now than prior to COVID, when it seemed like you were having market share battles between Russia and Saudi Arabia. We're coming through a period where there's been almost no major investment for 5, 6, 7 years, going back to 2014. The costs to produce are higher, so that generally means you need higher prices to spur new investment. And now we're seeing the effects of the Saudi production cut that just happened in May, and as well the US was sending barrels from their strategic reserve onto the market, and they've also stopped doing that. So we've had a bunch of supply come off the market. We've seen prices respond favorably, as we were talking about. The economy still remains strong with all the manufacturing activity. And in fact, I think there's a good indicator for GDP called the Atlanta GDP Now. You can Google that, and it tells you a real-time GDP estimate based on live data inputs. And they think, it's an estimate. It's going to change as we get through the quarter, but it's running close to 5% for the US, which is a huge number right now. So it seems like economic activity is still strong, which should, again, support oil demand. So we've seen prices improve. We don't think they need to improve too much further from here to still get nice upside on oil-based names. And so, it'll always follow commodity prices in the short term, but we think if prices stay at that $80 level for the foreseeable future, that'd be a nice level for Canadian companies.
Thank you, Jamie. And Bruce, I'd like to hand off to you. There is one more question for you in here, and I know you'd like to have an opportunity to thank everyone who participated in today's call. So the last question for you are, what are the top 5 choices for U.S. dividend stocks in a fully conservative portfolio with primarily a U.S. dollar income approach and modest growth expectations? And with that, I will sign off to you.
Okay, well, thank you, sir. And that's an interesting question. It's surprising we own 5 companies in our income fund that fit the bill, and I'll just run through them. The first one is British Petroleum. Now, we own it in the ADR form, so we get ADRs are shares of foreign companies listed on in New York, and therefore, and they pay their dividends, etc., in US dollars. So BP has about a yield of 4.7%, and as Jamie outlined, we think the outlook for oil is good. BP is also diversifying heavily into alternatives, wind power off of Europe, etc. So you do get a little bit of energy sex appeal with that. The second stock on our list then is Pfizer, and Pfizer we've just put into the income portfolio. Pfizer, as everybody knows, is one of the largest drug companies in the world, and had what up until recently had that record for the hottest drug product in the world, which was Lipitor, which obviously most anybody who's over 55 is on in some form or another. And Lipitor came off patent a few years ago, and then Pfizer happened to emerge with one of the winners in the COVID, and they made a ton of money during COVID off the vaccine business. But Pfizer has fallen back to the price below it was when COVID started, and Pfizer has a multi-billion-dollar pipeline of new drugs, and don't count Pfizer, they'll hit a few more. There's certainly singles coming out of the company every year, and there'll be a home run sometime in the next few years. And Pfizer has a yield of about 4.5% now, and we could see it easily rally back to $50. The next stock on the list has been the hottest stock in our portfolio in the short term, Cogent Communications, which is number 18 on this list. And Cogent is a supplier of internet services, or they have high quality cable to office buildings, and they're in Toronto, for example, but they've got a very solid high speed internet offering that is premium for businesses. And the yield on Cogent's about 5.4%, but the stock has rallied substantially recently. The latest quarter, they surprised everybody how well they're doing, and the stock popped, well, I think almost 20%. And then we own good old fashioned IBM, International Business Systems. International Business Systems yield 4.6%. They continue to grind along. Most of the world's banking industry still runs on IBM machines, and IBM is diversifying into new products, and they made some acquisitions of the hotter technology companies, but the core business is so big and gradually declining that it'll take years for this to happen. But in the meantime, they do pay a 4% dividend. They raise it a little bit every year, and things go on. So the last stock on the list then is Blackstone. And Blackstone is one of the big US investment managers. They focus heavily on real estate. And Blackstone has sold off on the fears of office building rents and higher interest rates, but they're mainly focused on industrial and housing type infrastructure. And Blackstone's dividend yield is about 3.7%. So those are 4 stocks that we think, or 5 stocks that we think you can hold for a conservative portfolio, and you should get a little bit of dividend growth out of them all over the next few years. And I'll leave it at that and thank everybody, our clients and our people who want to become clients and those just are interested for attending our presentation. We wish you enjoy the rest of the summer and into the fall, and we'll be holding another one of these events in November. Thank you all. Bye now.